In the modern equity market, a stock can only stretch so far before it reaches a state of extreme technical tension. This 3D chart shows AMD currently trading at $542.52. Look at this gap down to the baseline. The stock is floating 135% above its 200-day moving average. Retail traders often expect this trajectory to continue indefinitely, ignoring the structural boundaries capping the price action. Those boundaries take the form of a ceiling wall. Heavy call open interest sits squarely at the $550 strike price, creating a rigid mechanical barrier that options dealers must defend. And sitting far below the current price is a gravitational pull. The max pain node, the mathematical point where the maximum amount of options contracts expire worthless, is anchored at 515. AMD is physically pinned between this upward velocity and downward gravity. Its next move depends entirely on a single structural pivot point, the $540 line. To understand if that line will hold, we have to look outside of AMD and check the broader semiconductor sector proxy, the SOXL ETF. This dual-panel display tracks that sector capital. SOXL is currently trading at $280.54, but its implied volatility has reached the 100th percentile. The broader sector is showing clear signs of mechanical exhaustion. If the broader sector stalls, institutional capital inflows dry up. That starves AMD of the macro support required to sustain its current height. Without that rising tide, AMD's survival relies entirely on localized options mechanics right at that $540 pivot. Simulation 1. The opening bell rings, and AMD fails to defend the 540 pivot. Momentum dies immediately. Market makers holding underlying stock to cover their short call positions suddenly don't need that protection anymore. Their delta obligations collapse. To maintain a neutral book, these dealers are mechanically forced to dump their equity shares straight into the open market. This aggressive selling triggers a negative gamma cascade, pulling the stock price downward into the $515 max pain whirlpool. Automated liquidation cascades are purely mechanical. When a structural pivot fails, market makers must neutralize their exposure regardless of market sentiment. Simulation 2. AMD holds the 540 pivot, but trading volume dies, leading to a momentum stalemate. With implied volatility sitting in the 100th percentile, option premiums become incredibly expensive. The high cost of entry removes the leverage advantage of derivatives, which halts new speculative buying. The asset enters a high-float theta burn. The stock price flatlines, trapped inside a restrictive horizontal friction zone. As the week progresses, theta, or time decay, takes over. Market makers utilize this stagnant price action to systematically extract extrinsic value out of hyperinflated contracts. While the spot price barely moves, dealers quietly unwind long equity hedges over several trading sessions. Wealth transfers directly from retail option buyers into institutional vaults without a directional breakout. When opposing forces stalemate, dealers use time itself as a tool to bleed unhedged buyers dry. Final reset. Simulation 3. AMD defends the 540 pivot on massive, expanding capital volume. Relentless out-of-the-money call buying traps the dealers. Because market makers sold those calls, they are now exposed to significant upside risk. To insulate themselves, those dealers are forced into systematic, non-discretionary buying of the underlying stock to maintain a neutral book. This buying drives the price higher, which forces them to buy even more. It creates a self-fulfilling mechanical feedback loop known as an upward liquidity vortex. The sheer velocity of the squeeze overrides the downward gravity of the options chain and shatters the 550 ceiling wall. This explosive breakout is a reaction forced by dealers managing their own hedging requirements. The options market is a highly structured, fluid system governed by mechanical dealer response functions. This infographic models out the exact aggregate dealer liabilities. We can see the three probable outcomes mapped side by side: the crash, the sideways grind, and the gamma squeeze. By tracking dealer hedging requirements, volatility limits, and sector-wide gravity, the mechanical constraints of the chart reveal themselves. Generic chart patterns often ignore the mechanical engine moving the asset. Predicting the next move requires an analysis of dealer positioning and volatility boundaries. The $540 line in the sand is drawn. By understanding the microstructure, you know exactly what forces will trigger the next move.